The market's had quite a positive reaction to Transurban's latest earnings numbers. And I spoke to the CEO, Michelle Yabco, about what's given the group confidence to effectively upgrade the dividend estimate for the next 12 months, where the growth drivers are going to come from generally for the organisation over the medium term, and how autonomous driving could potentially be one of those levers. Take a listen. One of the best barometers of a company's earnings outcome is how the share price responds. And since reporting about a week ago, Transurban shares are up by about 7%. And particularly in Transurban's case, one of the things that delights investors is your dividend forecast. That was a big feature of the share market response. What's giving you the confidence at the moment to be able to predict that 69-cent payment for the next year?
Thanks, Tom. So 69 cents is about 6% dividend growth for next year. I think we've, in a pretty complex macro environment, I think we've worked really, really hard just to focus on the right things that we know will deliver value. So we had traffic grew everywhere. We took some hard decisions on our costs, managed the balance sheet well, and as a result, we feel pretty comfortable around providing that guidance for next year, which, as you say, I think is delivering what we say we're going to do. We delivered this year, and we're delivering what we say we're going to do for next year as well.
One of the features that stood out when looking at traffic numbers was, I suppose, the underperformance where Melbourne is concerned. There are some shifts that are taking place from a government perspective there. Is that something that concerns you?
So maybe, as I said, we grew everywhere in terms of traffic. Melbourne probably grew a bit slower than some of our other markets. When we think about our business, we take a pretty long-term view. So when we imagine Melbourne, we're thinking about 20 years from now. And when you look at the population growth in Melbourne, it's still very strong, particularly in some of the growth parts of the city. In 20 years, they're going to be 50% bigger than they are today. We've got the Westgate Tunnel opening in the next few months, which is going to add capacity in that part of the city. So we're feeling pretty buoyed about that. In terms of the numbers that we just saw, we grew about 1%, bit over 1% in Melbourne. It was really interesting. We had weekend trips did really well, probably similar to everywhere else. Airport trips were pretty good. Office occupancy is still around 60% in Melbourne. So there's been an evolution of workday, sort of work and lifestyle patterns. But, again, we take a 20-year view. Population growth is still the biggest driver.
And that's a wall, isn't it? That's a demographic wall that's just almost immovable when you look at the demographics.
In terms of the next
20 years, for example.
Yeah, exactly. And, when populations grow, people need to move around. They need somewhere to live. They need all the other infrastructure that goes around it. So, yes. But in the short term, as you said, we still grew, but it was a little slower than the other markets.
So there are a couple of blemishes, but the cost control side of things is a really big feature of your execution. How do you set out at the beginning of the year, to be able to really yank down on those levers when it comes to managing those costs?
And so it is hard. It's always the bit that's the least fun, if you like. But it was necessary. I think we'd grown very strongly as a business for a decade, and that was phenomenal. That growth was phenomenal, and it was just what happens, after you go through a period of such strong growth is duplication sort of comes into the business. And we were finding we were just less efficient in getting things done. Cost is actually an outcome of that rather than the driver. So a big part of what we did was really just to get the business more nimble and focused on what matters. To do that, we took some hard people decisions as well. But I think, we did that with care and empathy as we worked through it. And we are starting to see, I think, the benefits, not only in the cost numbers. As you say, we had costs flat for the year. We've guided to good cost control for next year.
To get it under CPI is like the holy grail. I suppose, is that something that can be expanded over a longer horizon?
So we do see it as we talk about it as a bit of a multi-year journey, on the basis that by getting really clear on what we're focused on and having the right people that then can do multiple things. We think as priorities evolve, we can actually work with a lot with the workforce we have. And so it is an area that we just want to stay disciplined on. We're still a growth business.
Yeah.
And so we're not sort of saying we're going to take cost out of the business, but we're going to make sure we're allocating the cost to the things we think are going to create the most value. So with the changes we announced in the last few months, we're investing more in our customer. We're investing more in further simplification because we know that will continue to drive sustainable longer term value.
Alan Fels has just done some work. He's handed it into Chris Minns. They're mulling it over. Does that fill you with dread when you see these types of bodies of work being conducted? So,
I mean, it's actually been a good process, and we're quite optimistic that there'll be a solution in the process that I think is positive for everyone. We've spent, alongside our partners, $36 billion over the last decade of investing in Sydney. I think the value of that does speak for itself in terms of time savings. Like if you're going from Parramatta to the city today, you can do it in half the time than 10 years ago. Sydney has 1 million more people, so that's and you can get to the airport now. The gateway's open 39 minutes faster, so the value's there. But the government has some different priorities. So the government's been very clear that they're not going to do anything to impact the value of contracts, and they're respectful of revenue and timing of revenue as well. So within that boundary, we can have good constructive discussions, and that's what we've been doing. It's been a really thoughtful process. It's complex because there's lots of stakeholders. It's a complex network because some parts of the network are newer with lots of capacity on the road. Other parts have building congestion, so changes can have knock-on impacts on drivers in different parts of the city. But I think we're feeling optimistic. There's a constructive, practical way through it. We're also really supportive of some of the other things that have been mentioned by the government in terms of simplifying the toll notice process, a stronger ombudsman, because we think a simpler, more effective process for everyone's going to be better. Yeah.
Now, dare I say it, sometimes you have to smell the political winds, and there's a moment where perhaps it's going to be less clear where your growth corridor is concerned. I'm curious to get your thoughts on how important the US is as a place where you might develop the next lever of growth for the company.
So maybe I'll give you the US answer, and I'll come back and talk more broadly, because I think it's not just the US. Actually, we feel there's growth in front of us. We're quite excited about a few opportunities. The US has been performing really, really well. We've got, since we opened some new roads over there, drivers are really seeing the value that our express lanes bring, and not just in peak times. And the way it works in the US is a bit different to here. So our price moves depending on congestion, and we have to maintain a minimum speed on the roads. What we've seen is even outside of peak times, drivers are really seeing the value in the express lanes. They like the reliability it brings them. And so that's been reflected in, we've got 6.5% traffic growth over there, but 20% revenue growth, because price is adjusted to reflect the value that people see. So that gives us confidence in the US. We've been there about 11 years. It gives us confidence to continue to invest there. We've got some good opportunities we're in the Greater Washington area. We've got some really good opportunities there that are essentially enhancements of existing roads, and we're in good discussions with the Department of Transport there. There's a couple of new markets where early days but exploring, and we're thinking Georgia and Tennessee in particular. They're big projects in new markets. You do have to think about it a little differently from a risk return perspective, so we're exploring some new partnerships there as a way to get the right risk return balance and then build a position that you can grow from over time. So we're feeling quite optimistic about both the organic opportunity in the US and then potentially some other expansions. In Australia, we talked about Queensland. We touched on Queensland. Population growth in southeast Queensland is probably the fastest growing market. You've got the Olympics coming in 2032, so we're engaged with government there on a widening of the Logan which already has a lot of congestion. We're looking at a couple of potential upgrades to the gateway there, so we think there's good opportunity, and there will be, if you take a 20-year view in Queensland, we think there'll be more opportunity even beyond that.
Time's ticking, though, for the Olympics in Brisbane. Is that enough runway?
So, yeah, I think what we did, originally we were looking at Logan and Gateway together as one project, and then with exactly, thinking about exactly what you said, Tom, with what else needs to be delivered in the lead up to the Olympics, we thought phasing it made more sense. So do the Logan widening earlier, potentially a couple of upgrades on the Gateway, and then over time, the rest of it, can come after the Olympics as well. So I think we feel pretty good about Queensland. It will need more freight routes as the population grows as well. And then the other thing I'd say we're trying to do as a differentiator for us for growth is not just the way we're working as a partner, like I talked about on toll reform in New South Wales, but just investing for our customers. Because my view is if customers, the users of the road, see the value in the time they save, the quality of the trip, then we've got a good differentiated position as governments explore new ways to help growing populations. And so we've been, one of the things we talked about doing in the next couple of years is a resheeting of the M2 here, to make sure it's a really good quality experience for drivers as they're driving on it. We've put a lot of investment in our digital experience. So today, 97% of our customers interact with us through digital means, off the road, clearly. And now on the app, you can see how much time you've saved. So, last month I spent X dollars, I saved this much time. We want to roll out fuel savings. So you can see how much, usually you save about 30% your fuel usage if you're not stopping at traffic lights and the like. And then we've got rewards. So we're trying to do a lot to create a really strong value proposition that we think differentiates us for future growth.
You necessarily have that 20 to 30 year time horizon, and included within that, particularly in the US, for example, is the question of autonomous driving. And these two themes just seem to go hand in hand. How much thought has been devoted to that concept?
I always say, I learnt in a manual car. My kids are learning in automatics, and my grandkids probably won't learn. That's the way I sort of think about it. But they will still travel by car. They just might not be physically driving it. So we see that with that happening, road transport will actually become cheaper and cheaper over time, and so will increasingly be an effective way for people to drive. So we're still, very positive on road transport. Over a couple of years ago, we ran some trials for autonomous trucks. We did it down in Melbourne, and we essentially had an autonomous truck running at night from the port out on CityLink, and then beyond CityLink on the Monash to one of our customers' distribution facilities. And what we were able to do was open and close the lane around the truck. And also the truck, we've got a lot of technology in the road in Melbourne. The truck was able to talk to the sensors in the road and know the conditions sort of a kilometre or so in advance. So we think with technology, there'll be lots of different opportunities to make, freight's going to grow at a multiple of population. So finding ways to make that more effective for the people that work in that industry, we think will be real positive, but it's some time away. It's not sort of tomorrow's thing, but we'll continue to sort of explore opportunities in that space.
It's incredibly exciting.
It is really exciting. And I think it is that intersection of how the technology, and whether it's connected and autonomous vehicles, whether it's the electrification of vehicles, whether it's the way, changes in just the way customers engage with digital tools today. We think that is a real possible differentiator for us into the future, so we're quite excited about it.
Michelle, it's been a delight chatting to you. Thanks for your time.
Thanks, Tom. Thanks so much for having me.
And thanks very much for joining us for the Executive Series.